I think we'll go ahead and get started. Welcome, everyone. Thank you for taking time to participate this afternoon. Tax issues are coming fast and furious now, so we appreciate you participating in this call this afternoon and participating in the council. We have a number of things to talk about. I'll ask Senator Lee if she has any comments before we get started.
No, I'm just glad to see everybody here to join with us in the conversation.
Well, very good. With that, we'll get started and we'll call on Secretary Burkhart for revenue updates.
Thank you very much, and good afternoon, everyone. You should have been provided two documents that I'll make reference to today. One of them is what is affectionately referred to as the short memo. This was a memo that was done by Legislative Research and the Division of Budget after the CRE. And that memo is on Legislative Research letterhead. And then you will also have a short memo from me that will touch on just a very few issues to bring you up to date on some developments since we last met. So let's visit very briefly, I guess, about our new consensus revenue estimate. And I will be making reference to page 2 of the Legislative Research document, and table 1 of that document reflects what total receipts have been over the last couple fiscal years. And you can see that the consensus revenue estimate has made some adjustments in April. I would let you know that for fiscal year 2021, we had met last November of 2020. 20th of this year, we increased the estimate for FY 2021 to $8 billion at this point in time. The increase was nearly 320 million. One of the points I want to make about that is, and we talked about this before, between 500 and 550 million has been moved from fiscal year 2020 to fiscal year 2021 as a result of the federal filing extension and state filing extensions that we did last year. So that accounts for a significant movement of dollars from one fiscal year to the next. That accounts in large part for what has happened in terms of the increase for fiscal year 2021. For your fiscal year 2022, again, an upward adjustment, but not nearly as meaningful, roughly 41 million increase. So I guess the point to always take into account is the fact that we've had some movement of money between fiscal years, and that made a bit of a challenge for the consensus estimating group to sort of determine how that was impacting our receipts or would be reflected in our receipts. The other point that I wanted to make on the revenue numbers is the fact that the new consensus revenue estimate takes into account the fiscal note for the payroll protection payments that we've been dealing with over the past year. The department and Division of Budget, we came up with a $360 million fiscal note. That's a negative fiscal note to the state. And that was taken into account when coming up with the new consensus revenue estimate. If you look over on the top of page 2 of my memo, you will see a reference to the Paycheck Protection Program. And you'll see a ways down under that paragraph how that fiscal note was spread between fiscal years. So again, the point being that there was a meaningful fiscal note associated with that particular issue. And again, we had discussed this, I think, at our last meeting, but now the consensus revenue estimate actually reflects those numbers. So yeah, Josh is pulling that up now, and you can see how that impact is spread among those fiscal years. And that's exactly for fiscal year 21 and 22. That's how it was taken into account. So again, referring back to table 1 of the CRE memo, you can see for fiscal year 21, the estimate was adjusted upward at 8 billion. And then for fiscal year 22, we're back down to 7.5 billion. And again, we didn't have any movement of revenue from FY21 to FY22 because of any type of extension. Now, as you know, we did do an extension for individual income tax from April to May, but that obviously is still going to be in the same fiscal year. So anyway, those are the current numbers from the consensus revenue estimating group. Let's flip back over to my memo, I guess, and let's just have a comment or two more about the Paycheck Protection Program. There has been a little issue in terms of the fiscal note that was arrived at. And keep in mind, this has all come about by the federal tax treatment of these loans. So for federal purposes, these loans, when they're forgiven, that amount is not included in gross income for the taxpayer. So there's no tax on that, no tax at the state level, because we are a rolling conformity state. The federal treatment is what Kansas is going to accept on our state return. So again, no inclusion of that income in the state tax base. What the IRS had done in 2020, they had a ruling, a revenue ruling, that basically said, that's right, if the loan is forgiven, any expenses paid with that loan or those loan proceeds would not be deductible. And so basically that ends up in a wash, if you will. That was the case until December 27th of 2020, when the Consolidated Appropriations Act was passed, and those expenses then became deductible. And taking all of that into account, there is a double benefit, if you will, to taxpayers, which is reflected in the fiscal note that was arrived at on the treatment of PP loans and related expenses. So again, we communicate with other states, and all rolling conformity states look at this issue exactly like the state of Kansas. And there is a meaningful negative fiscal note for the state associated with the PP loans and the expenses that are paid with those loans. So the next item I just wanted to touch on, and obviously this is something that's all of you already know, but the governor did veto Senate Bill 50, and we had gone over Senate Bill 50 in a fair amount of detail in our last meeting. Again, just included the schedule which summarized the components of that particular piece of legislation. Just wanted to comment on a couple of those items. perhaps the most meaningful from our perspective, because this is an important issue that Kansas needs to address at some point, and that deals with marketplace facilitators. And again, the council had its own proposal, very well drafted legislation. The council's proposal did not have a de minimis amount in it. This particular provision in Senate Bill 50 did have a de minimis amount in it, and that was 100,000. But what's meaningful about that de minimis is it not only applied to marketplace facilitators, perhaps more importantly for our purposes, it applies across the board to any remote seller. And that has a meaningful impact on the state of Kansas. You know, since Wayfair, we've had a lot of developments at the department, and in terms of, you know, how we're trying to get out-of-state retailers to get registered with the state of Kansas and basically start collecting sales tax or use tax on the internet sales. The Wayfair decision came down in June of 2018. The department issued a notice, as you know, to taxpayers informing them of the Wayfair case and what Kansas law provided. That occurred in August of 2019. Since that date, and we just checked these stats this week, since that date, we've had over 12,000 new registrations of companies out of state that are collecting and remitting compensating use tax. So for the first 9 months of this fiscal year, we've collected $46 million from these new accounts that were created after the department had sent out its notice. Obviously, a number of these companies that are registered are small retailers, but nevertheless are registered and are collecting and remitting tax to the state of Kansas. On an annual basis, this means like $9 to $10 million of revenue just from those small retailers. So it's pretty meaningful from a dollars perspective that this tax, which has been due since 1937 on these transactions, that it actually be collected and remitted to the state. A couple of the other meaningful items, again, that we've talked previously about in Senate Bill 50, the provision dealing with the itemized deductions. This particular bill had itemized deductions and an increase in the standard deduction, but the itemized deductions component is the part of the bill dealing with individual taxpayers that was very concerning to the department, really from a compliance standpoint. And that concern relates to the fact that without some meaningful changes in expenditures, there's no real good way to verify deductions that would be claimed. Because again, this is a situation where a taxpayer is going to be claiming a standard deduction at the federal level and then itemized at the state level. So the audit responsibilities would increase dramatically at the department. And I think Dr. Ginther is going to maybe address this a bit later in her presentation, but the individuals who would be able to utilize itemized deductions, we're probably talking the top 18% of income earners in the state. That's where most of that benefit flows. Another item that has been discussed quite frequently again is the treatment of GILTI income, foreign source income. And again, Dr. Ginther, I think, will address this a bit later. But again, this is another one of those areas where the benefit derived from the legislation is really focused on very few companies. Fact of the matter is, over 60% of the companies filing C corporation tax returns don't have any taxable income in Kansas. So the companies that would benefit from this type of tax relief is a very small number. And again, I think Dr. Ginther may get into the specifics on that a little bit later this afternoon. So that's all the comments I want to make about Senate Bill 50. Obviously, with the legislature coming back for the veto session, this particular measure is going to receive a fair amount of discussion again. The last item that I just wanted to touch on again, and again, I'm confident many of you have seen articles that have come out since our last meeting, but just wanted to touch again on the provision in the American Rescue Plan that basically says that funding, federal funding, may not be used under that particular plan by states to offset reductions in tax rates, the creation of exemptions, deductions, whatever there might be to actually reduce taxes within the state. There is a number, well, there are a number of cases filed around the country by various states to try to get that particular provision set aside. It's interesting to read the analysis of constitutional law experts in terms of the viability of that particular type of cause of action, and it will be interesting to see how that all plays out. Since the litigation is relatively new, there really haven't been any meaningful developments, at least as of this morning, unless something has changed. But again, as the council looks at issues before it, and even the legislature, when they look at tax legislation, this needs to be a consideration, because if you read the language of the statute literally, for every dollar reduction from a tax cut, that same reduction would occur in funding coming from the federal government. So it's a dollar for dollar offset. So I believe the Urban Institute will probably put a little more meat on the bones on this particular issue again a little bit later this afternoon. So those are just the issues that I wanted to touch on to bring you up to date on, and then just provide you the current CRE numbers. So I'd be happy to answer any questions you might have.
I do have one question on that provision that you were just discussing. It seems to me like the federal government has always had restrictions on money that they furnish to states. And why is this different than that?
Well, that's the issue that'll have to be decided by a court. That there seems to be plenty of examples where the federal government has strings attached to its funding going to the states. It's a very, very difficult burden to set aside an action because it's unconstitutional, and the states who have commenced this litigation, they have a great task ahead of them if they intend to be successful.
Yeah, this is Kim. I would just add, so I've been in conversations with constitutional lawyers and tax lawyers, and a lot of this seems to pivot on the inclusion of something that says an indirect tax cut. So it's sort of whether the phrasing of the rule is sufficiently vague to not be practicable. At least those are the conversations that are going back and forth here in Washington of the law professors that I know.
Cam, did they discuss the possibility of the Treasury just promulgating regulations that puts more clarity into that term?
And that is basically the question, whether they basically try and make it more specific and maybe take out that part, right? So thus far, the only thing we've gotten out of Treasury is anything that conforms either directly or indirectly with federal policy does not count as a tax cut, but we haven't gotten any of the new enabling legislation. And I just checked the Treasury site yet. So they're still working on it.
Okay.
But I think that's the question about whether Treasury can define it in a way that the courts will then find it acceptable or not.
Further questions for the secretary?
Mr. Chair, I've got a question. It's actually more of a comment, if you don't mind. This is Adam Proffitt.
Sure.
And you know, I want to avoid getting into the public back and forth really as it relates to the PPP, but Secretary Burkhart mentioned the analysis that revenue went through and the DOB certainly supports as it relates to the fiscal impact of the allowability of deductions of expenses related to PPP loans. There are some that would argue that there is no fiscal impact of the state, right? And say that the joint, the JTC even said they intended it to be $0 impact. I think when the Treasury came out with their most recent blurb on April 7th, and it's on page 3 here, they're reacting to the number of states that are trying to conform to federal tax code to allow these expenses to be deductible, recognizing that there will be a negative fiscal impact of the states. So the Treasury specifically stating, yes, if you want to be conforming to the federal regulations as it relates to PPP expense, that will likely have a negative impact on your state revenues. You'll be held harmless from that on this particular provision. So I think it just kind of puts a fine point that the Treasury is also recognizing states are struggling with this and that there will be a negative fiscal impact. And that's just a comment.
Okay. Further comments or questions?
Chris has a question.
Yeah, Mark, just to follow up on the budget director's comments regarding some of the decoupling issues and the PPP stuff. I guess looking back at the consensus memo, it looks like there was a significant increase in the corporation income tax estimate for fiscal 21, right? Some $124 million. And it looks like that estimate is now north of 500 million. And I guess my observation would be that some of these so-called decoupling issues associated with the 2017 federal tax law change, like GILTI and the limitation on deduction for business interest, some of those issues have been around for several years now. And because we have not thus far decoupled, it doesn't seem to me that an asteroid hit the earth in terms of corporate profits having been damaged relative to our current receipts. And I know you've talked in the past about how the corporation income tax is very sort of top heavy anyway, where a lot of this money comes from the top sort of 1 or 2% of the corporate filers. And then I guess just on the whole notion of decoupling, had Kansas chosen to decouple, or someone suggested we decouple from this $360 million loss we're talking about because of the PPP thing, I strongly suspect that the people wanting us to decouple from GILTI and the limitation on deduction for business interest would oppose the notion that we decouple from the federal treatment of PPP. So decoupling, in that whole debate, there are no purists. It occurs to me people want us to decouple when it helps them and not when it hurts them. It's just an observation I guess I'd throw out there, and feel free to react.
I guess I can't disagree with what you've said. Yeah, I mean, it's if you're just looking at the bottom line, you decouple when it benefits you and you don't if it doesn't. So yeah.
This is Senator Sykes. Just a question. Do you have a breakdown on the cost of the itemized deductions versus the increase in the standard deduction? Those two pieces?
When those are combined in the same bill, as I understand it, we are not able to break those out. And it's the relationship between the two that makes that unable to be done. And I'm checking with our Director of Policy and Research. Is that correct, Kathleen? Okay. Yeah.
It seems like I heard that there was a $25 benefit with the increased standard deduction for the average person.
Yeah, I guess my question would be, I mean, we had the proposed bigger increase in the standard deduction, and just looking at the bottom line, that would have helped all Kansans versus less than 7% of Kansans with that decoupling for the itemized deduction. So just trying to put together a good argument when we're discussing this over sustaining a veto.
Yeah. Well, and you're exactly correct. Doing any adjustments to the standard deduction basically impacts over 1 million taxpayers. And the number impacted by allowing itemized deductions, if you don't itemize at the federal level, the number that are impacted, it's a much, much lower number. Yeah, it's just a question if you're granting tax relief, who do you benefit and how many do you benefit?
Other questions?
Chris has a question again.
Oh,
Okay.
one more, just to follow up on Senator Sykes' question. My recollection is earlier in the session when itemized deduction was going to be considered by itself, I seem to recall the fiscal note was about 60 million per year. And I understand the point that revenue is making, that when you're doing two things at once, if you're raising standard and allowing itemized, and taxpayers have this interactive option about which one they're going to take, it's hard to pull it apart. But in my very simple mind, I would suggest that the math might be that way, right? If itemized on its own ticket costs 60 and now the combined fiscal note is 83, that's putting the standard deduction increase by itself under $30 million in my mind. And I know Josh has sent us out something that on some other analysis, it might be around 30 or 34 million. But my point is, if we cannot disaggregate the fiscal note and it's 83 million, the lion's share of that is still associated with the itemized piece that the department does not like for some of the compliance reasons Mark described.
I would remind the council that our recommendation was to have a larger increase in the standard deduction in lieu of itemized deductions. Further questions? Well, if not, thank you, Mr. Secretary. And
Thank you.
Senator Holland, are you on?
Yes, I am.
Well, Senator Tom Holland has some property tax, or a property tax issue that he wants to visit with us about. And we actually heard from him a couple of years ago, but I think there've been changes, a lot of tax changes. So we appreciate you taking the time to brief us on your property tax proposal, Senator Holland.
Council, thank you so much for visiting. Give me the opportunity to visit briefly today. I have to apologize. I'm actually visiting in-laws, so I'm looking rather informally at you today. Staying outside my in-laws' house on the sideway to talk about this briefly. So basically what I bring before the council today is something I've continued to work with. We passed a version of this out. It resides below the line, and I'm talking about the Golden Years property tax relief plan. As the committee will recall, the council will recall, we currently have 2 circuit breakers currently in program. We have a homestead property tax relief program, and then we have something called the Safe Senior program. And the program that I have been working on the past 3 years basically is intended to address the ever facing property tax pressures that our fixed income seniors, as well as say our disabled physical veterans face, where they have limited income, and yet they particularly say when they reside in areas like Northeast and South Central Kansas, in our urban suburban environments where you have high growth areas. And you also have the situation or phenomena of basically commercial property taxes being abated in those same areas. You get further and further shifting of that tax burden onto our residential property owners. The reason why I feel this policy is particularly appropriate to look at and for consideration of passage is really a couple factors. We know that with the onslaught of COVID, that basically you have a lot of fixed income earners now in their early 60s. They will have been hit negatively from an economic standpoint. Their current earnings have been reduced, and so their incomes have been further reduced because of limitations on changing economics, either being underutilized or downsized out of employment. We also have the phenomenon of basically, I personally believe that you're going to see a lot of our elderly seniors who are previously planning on going to either independent or assisted living accommodations. I believe those plans have now been basically thrown up in the air. My guess is, particularly with giving more economic challenges, you're going to see our elderly population who are homeowners basically make the decision to try to basically have their remaining years in their homes. And purely from a state policy perspective, delivering Medicaid services and just quality of life issues, I think it really makes sense for the state to through all appropriate measures, basically try to keep our fixed income seniors in their homes until they do pass, if that is in fact their choice. I think it's just a much more common sense, effective way to handle our aging population here in the state of Kansas, given the economic circumstances. So basically, the framework of this is typically you have an age limit of where a qualifying person or couple can, quote unquote, freeze their property tax payment. It's based on an annual income ceiling, as well as a appraised value of their homestead property. And the concept is that basically every tax year after that, they will continue to pay what they dutifully owe the county treasurer, but what they will in fact do is receive a rebate check back from the state, for the difference. So as their property tax bill grows over time, our local units are made whole because they receive the tax payment in full from the homeowner, but the state picks up the difference. In fact, what this program provides is property tax certainty for our Kansas fixed income seniors. Make no mistake, there are a number of circuit breaker programs throughout the country. As I said, Kansas currently has 2. We're talking about a third one here. And many other states have these as well. The beauty of these programs is that you avoid a lot of constitutional problems. This basically does not have any, because we're still treating all property class owners the same within a class. The state is just making a policy choice to provide a rebate to certain individuals within that, which is totally legitimate. Obviously, the program also keeps our local units whole. So that's really the beauty and the directness of being able to have a policy like this. We have in the current, and once again, I'm not, you can basically assess the current circuit breaker programs we have on their own. I would point out that a second program we have, the Safe Senior Program, it appears to be addressing a very small group of homeowners. And for those that qualify, for a portion of those folks, it actually is providing some rather rich rebates. A couple years ago, when I was first looking at the Safe Senior Program, I was aware at the time of certain of our homestead owners receiving rebates in excess of $5,000 a year. I would point out to the council that respectfully that we have many, many fixed income seniors in the state. Once again, I believe this is particularly in our northeast and south central regions of the state that face these ever rising property tax issues. They don't have access to anything like our Safe Seniors do. And I think we need to broaden that benefit out once again, under the guise of keeping seniors in their homes. I believe Josh has put together some basically PDF or presentation documents there for your review. We've had
Questions for Senator Holland? Well, thank you. You've done a good job of explaining it, Senator. Certainly appreciate you coming to us and briefing us on this proposal. Wish you good luck with the veto session.
Thank you, Steve, for those comments. If there are specific, I guess, comments or critiques that people would like to share with me offline, they've got my Senate email address. I'd love to hear them. This is a policy I continue to pursue even more strongly than before, just because we have a lot of seniors that are suffering with this issue. And this is the number one issue I hear year in and year out from my constituents. Of course, I represent, Northeast, districts in Northeast Kansas, but I mean, this is a very significant issue for our fixed income seniors, and would like to see a solution for them at some point. Thank you so much for your time.
Thank you, Tom.
Thank you, Tom.
Next, we will have a budget update from our budget director, Adam Proffitt.
Thank you, Mr. Chair. Can I get a thumbs up real quick? The folks can hear me, please.
Yes.
A lot of thumbs. All right, very good. Thank you. Yeah, so I am going to talk to everybody about the other side of the ledger as it relates to the consensus process, and we'll talk about caseloads, and then dovetailing the two together, I'll show a couple of profile scenarios. Before I go any further, I will state that the profiles that I'm showing are effectively agreed upon through fiscal 22. I will show beyond fiscal 22, but they are not agreed upon by any of the revenue estimating groups. They're simply assumptions that we bake in with growth and revenues or costs. So I want to make sure everybody has that as a backdrop before we move any further. But with that, let me try to share my screen here. And let me know, Josh, if you can give me a thumbs up and you can see the screen. Very good. So this is, I just pulled this from the GBAs, the governor's budget amendments that I presented to both the House and the Senate this past week on Monday and Tuesday. This is the adjustment for human services caseloads. In short, the cost for caseloads going forward has dropped dramatically versus our previous estimates, to the tune of $189.5 million of SGF in fiscal 21, $141.6 million in fiscal 22, or across the 2 years, $331.1 million of SGF reduction in expenditures, or $622.5 million all funds. And again, that's good news to the SGF. There were really two driving factors that led us to this conclusion. First and foremost is, as everybody knows, during the public health emergency, we've been getting a 6.2 percentage point increase in the FMAP applied to the entirety of the Medicaid program. What that does is it gives us about $50 to $60 million of extra federal money to fund that for every quarter that is in place, which means that the SGF contribution drops by about $50 to $60 million. It's tied directly to the public health emergency, or the PHE. In November, at the time of the revenue estimating group, or the caseload estimating group, the PHE was only going through January, so we could only recognize enhanced FMAP through calendar year 2021, quarter one. Since that time, the public health emergency has been officially extended through July, which means we can now recognize 2 additional quarters of that 6.2 percentage point enhanced FMAP. So that provides somewhere in the neighborhood of $110, $115 million of SGF relief across those 2 quarters that we didn't have in the profile before. So that's part one of the equation of why we're seeing so much good news on the caseloads. The other side is, as I'm sure most folks know, one of the conditions by which we can receive the 6.2 percentage point FMAP is we cannot disenroll anybody from the Medicaid program unless they move out of state or ask to be disenrolled. Stated differently, folks have continuous eligibility during the public health emergency for Medicaid or for CanCare here in Kansas while we're receiving the 6.2 percentage point increase. So in the fall, we were estimating that the population growth for the can-care program was going to continue on this pretty steep upward slope, which obviously we pay a capitated rate to the MCOs for every member. So that had a huge cost implication. Since that time, we've seen a reduction or a lowering of the slope, if you will, and kind of leveling off or a plateau in the Medicaid population. So we were able to reduce our estimate for the total population that we're covering for the balance of fiscal 21 and then into fiscal 22. So that's really the other big factor that's driving that. So again, between the enhanced FMAP for additional 2 quarters and population reduction and a cost reduction, we'd estimated a higher growth in costs. It's not coming to fruition, which is a really good thing. It means we have a healthier population. We were able to, again, reduce the estimates for what it would take to fund can-care by $331 million SGF, $622 million all funds over the next 2 fiscal years. Any questions on that before I move over to the profile?
Was that in the CRE estimate, Adam?
Yeah, well, yeah, it was the caseload side of it. So the CRE is the revenue side, the caseload side, yes. That got presented to the legislature on Monday and Tuesday as well by KLRD, and that is now baked into the profile. So hearing any other questions, I'll shoot over to the profile. And again, this is just, it's only assumption driven beyond fiscal 22. Let me increase the size just a little bit. So I'm going to show 2 different scenarios. One is assuming that the veto of Senate Bill 50 holds, and there is no Senate Bill 50, which is a reduction in revenues, as we all know. And the other would be if Senate Bill 50 were to be overridden, what that does. So again, the profile through fiscal 22 should be tied out pretty closely to what KLRD has, because, you know, as a revenue estimating group, we all agree on the number for what revenues and caseloads will be. What a lot of folks are going straight to, as is, you know, it's normal human response, is the ending balance. The combination of the increase in revenues that Secretary Burkhart spoke to, plus the reduction in SGF expenditures required for caseloads, means that we have a much higher ending balance at the end of fiscal 22 than we had first anticipated. It's really good news for the state, right? It means we're able to fund the programs that, or we had the opportunity to fund the programs that we had to cut throughout the last year as we were trying to navigate the pandemic. So the ending balance is showing at $821.9 million for fiscal 22, but this does not include any of the GBAs. It does not include any of the omnibus items that might be up for consideration. Specifically, obviously, we'd like to see employee pay raises in there that the governor had in her recommendation. This is just as of House Bill 2007 passing, and we assume a clean education funding in there as well. So while there is a strong ending balance for fiscal 22, $821.9 million, if you go a couple lines below that, you look at the structural balance. And the structural balance is nothing more than revenues less expenditures. So are we spending more or less than we're taking in? So even with the good news that we saw on the revenue side of the ledger, and even with the relief that we saw on the expenditure side of the ledger, we are still structurally imbalanced for fiscal 22 to the tune of $336 million, meaning we are spending $336 million more than what we are taking in for fiscal 22. So yes, we have a very healthy ending balance. It's a very good thing, but we still have structural imbalance, which means that the ending balance will deteriorate rather quickly. So if we move over to fiscal 23 here, again, this is all assumption driven. The revenue estimating group and the caseload groups have not met on these. But if we assume a 2.8% growth rate in revenue, we assume a modest growth rate in caseloads, this is what fiscal 23 would look like if we extrapolate it out. I did make an adjustment in here on the caseload side. There was a modest increase in caseloads on the base, and then I added $50 million of cost because, again, with that public health emergency, we received about $50 million of good news for fiscal 22 Q1 that won't repeat itself likely in fiscal 23. So we have to account for losing that federal funding. If these assumptions hold true, and they may or may not, again, structurally imbalanced in fiscal 23, and our ending balance is $315 million, which is only 3.8% of expenditures. As this group knows, when the governor puts together her budget, we have to end with a 7.5% ending balance. So this is about half of what would be required. Again, this does not reflect any of the governor's decisions or anything, but the point I'm driving towards is, yes, we have a healthy ending balance in fiscal 22. We have a lot of momentum on the revenue side. The economy does look like it's recovering to near pre-pandemic levels, but we still have some work to do to make sure that we don't completely erode our ending balance before we move forward with any other profile altering decisions. If we assume that Senate Bill 50 were to be overridden, excuse me, that's the only adjustment that I've made on this scenario. So taken out, and it's a little bit more than what the SGF would be, but it's close. We would remove $105 million from each fiscal year 22 and 23, because that's roughly what the anticipated hit to SGF would be with Senate Bill 50. Now you can see that our ending balance for 22 is down to 716 million, still pretty healthy, I'll admit that. But again, our structural imbalance then grows by that amount. So now instead of being $336 million structurally imbalanced, we're $441 million where expenditures are exceeding revenues. Move forward to fiscal 23, again, just assumptions of a 2.8% growth in revenues and a modest growth in caseloads. Add in these 2 years of reduced SGF from Senate Bill 50. Now we're down to $100 million of ending balance, 105.5, which is a 1.3% ending balance. So you can see that very quickly we start to erode that ending balance. Again, we can make some different decisions on what to do here, but the point is things are looking good. The economy looks like it's recovering. Things are on a very good track. We just need to be very judicious with our spending and our decisions as we move forward. And with that, Mr. Chair, I would stand for questions.
Other questions for the budget director? I think those figures that you just went through, Adam, are very significant. The 350 out of balance figure for this year, and then if you add in Senate Bill 50, and it adds to that, plus the ending balance in 23 with a 611 million negative spending. Any questions, comments?
Looks like Chris Courtwright has a question, Mr. Chair.
Chris?
Yeah, Adam, a couple of questions. One of them is relating to what someone mentioned earlier, especially regarding Senate Bill 50. It's certainly possible that any fiscal note that we end up incurring from Senate Bill 50 or anything else could end up being effectively doubled if in fact we have to turn around and then reimburse the federal government by a like amount of the net of those tax cuts, right? So that would be an additional concern. And then I guess my question is, and maybe this is for you, and I know Kim Rubin, Urban Institute later, do we have any updates or new information on the timing of when the American Rescue Plan money would sort of be arriving in our coffers?
I'll offer my thoughts first, and Kim, if you want to jump in, please feel free. Short answer, Chris, no. We have not. I have not seen anything come through the Treasury or from my association, the National Association of Budget Officers, State Budget Officers. There are some deadlines that you could assume based on the timing of the bill, right? Generally speaking, it's within 60 days of the bill becoming effective. So that would be May 11th would be when we would assume guidance and or the funding. But we still don't even know if we'll get the funding all in one tranche or a couple of different buckets. Secretary Burns Wallace leads the recovery office here in Kansas, and I assure you their team is very, very much in tune with what's happening, and they would be the most up to date locally. But Kim, please offer your thoughts if you have something.
Yeah, I don't know anything else. Like I went to their site and I've talked to them, and mainly the only new thing that's on there since the 15th is telling people to register for a number so you could actually have the money remitted to you. But there hasn't been any action in sort of having regs come out on what it means and how it would be put into place.
Further questions or comments? Thank you, Adam. Now we have an update from the Commission on Racial Equality and Justice. Shannon, are you on? Shannon Portillo? Josh, do you know if she's going to be on?
I know that Kate Davis just joined, and she works with the Commission on Racial Equity and Justice. So it appeared Ms. Portillo was going to be available, but if we need to move it to a different part of the presentation, that should work. And actually, yeah, we're just a little bit early. So if you want to move on to the next one, that would be fine.
Yeah. I guess you're up. Thank you for being part of this today.
Is this me? So I'm going
Yes.
before Donna. Okay. And thank you for having me. I'm going to try sharing my screen. We'll see if this works. Microsoft PowerPoint. And the short answer is, can you see my screen?
Yes.
Yes. Okay. So I'm going to go through a bunch of alphabet soup. The bottom line is I don't have a lot to add about what's going on with ARP, with the rescue plan and the jobs plan, in that we still don't have a lot of the details, but I'll give you sort of my sense of what is going on with the America's Family Plan, which just came out yesterday. I have now realized there is actually a difference between having these events on Thursday rather than Friday if the bill comes out on Wednesday. So people I'm working with are actually having their meeting to figure out if we're going to be modeling the tax part of this. So I'm going to be giving you some information. I'm hopeful that by the time of your next meeting or sometime over the next couple of weeks, I could actually give you some information about what this looks like at the federal level in terms of what the pay-fors will look like and what the sort of tax credit part of this will look like from stuff that Tax Policy Center is doing. So just to review, we have about $6 trillion in federal legislation in play right now. There's the American Rescue Plan, which was passed, that we're still waiting to figure out how that $350 billion in state and local aid is going to be remitted, and what the rules are and what it's going to end up playing out in terms of what the state tax cut restrictions look like. So we don't really have much new information from the last meeting, besides the fact that just confirming that anything that conforms with what the federal government is putting into place will not count as a tax cut. So if you think about some of what we're going to see in the American Family Plan, I'm guessing those rules will also apply there. So it might mean that there are other things like expanding the earned income tax credit for longer that won't count as a tax cut, that we know that explicitly, but that might be getting ahead of ourselves. So we went over the American Jobs Plan. That's still not sort of tied down. After last night's discussion, it seems like there might be some pulling out parts that could be popular across the two parties and trying to get passed individually. So some of the stuff on infrastructure and seeing if that sort of gets decoupled from some of what they're talking about in terms of taxes. But that's just sort of some of the discussion that's going on in DC. So the American Jobs Plan was about like transportation, energy efficiency, housing units, affordable housing, broadband, domestic manufacturing, and some home care services. It was largely being paid for with federal corporate tax changes. A lot of the discussion that had been going on over this month in Washington was whether Democrats were going to demand some sort of SALT change. So lifting of the SALT deduction from some of the states like California and New York, but we haven't actually seen any movement in it at any point. So yesterday, the president introduced the American Family Plan, which has a major focus on education, both free pre-K for 3 and 4 year olds, free 2 years of community college, expanding childcare, expanding healthcare, and extension and expansion of some of the credits that we saw for child tax credits and earned income tax credits for childless workers that were originally introduced for a year in the American Rescue Plan. So part of this is doubling down on what we were seeing before, and it's largely being paid for by what we saw the president propose during the election in terms of increasing some of those rates on very high income people and trying to increase enforcement. So I'm going to go through this a little bit more slowly. I have additional slides I wasn't necessarily going to go through on what we did last time. It was just so that you have it all in one place if you're interested in some of the details. So this is something that I just cribbed out of today's New York Times. I thought it was a really nice picture that sort of highlighted how the money would be spent from both the infrastructure plan and the families plan. So this is the jobs plan is the pink one and the families plan is the greenish one. The other thing to note is that about $800 billion of this is coming from tax credits that are going to be targeted largely for low income and families. So low income families, and then also to expand some of what we see on the ACA premiums that we already see right now from the American Rescue Plan. Other things that we see, there is money in there to expand the IRS staff so that they can actually collect some of the money that they're going to say is going to be a major pay for this in terms of enforcement and trying to get enforcement up. A lot of this money is going for child and family support. So things like paid family leave, childcare, limiting the amount that low-income families would have to pay for childcare to 7% of their income. And then a lot of it is on the education side. So both on the 3 and 4 year olds getting free pre-K and on free 2 years of community colleges, something that isn't necessarily the purview of this committee, but something that sort of I feel like is worth noting. There is pretty big state matches that are sort of assumed in both of these programs. So I think on the community college money, I think they're sort of assuming it is about 25% that will be at the state level. So they're assuming that states will come up or locals will come up with a 25% of the money that is going to go to access the free community college money. And then on the pre-K, it starts at 10%, but is supposed to rise up to 50%. And there's some language if states don't go along, that local areas could go along in some other ways, but that's just sort of something to keep in mind that to access some of this money, there might be increases in what is expected for the state to pay for. All right, I'm gonna just keep going. So the American Families Plan, and again, this is very loose. This is an outline. Trying to get the details was hard. This $800 billion in tax credit is basically by subtraction of the amount of money that they're saying are going to the other programs. So I think I covered most of this already. And the $80 billion for the IRS investments, that's to increase enforcement and also to help people access some of these monthly child care credits. So as part of the American Rescue Plan, part of it was actually remitting the child care credits on a monthly basis rather than on an annual basis, which is going to take a fair amount of new administration from either the IRS or Social Security or wherever that's going to be. So I think right now the discussion is that's going to be happening from the IRS, but those are some of the things that there are some conversations about. And so this is over 10 years. Something else to think about is the expansion in the child credit and the earned income tax credit, especially making the child credit fully refundable. That is legislated as a permanent change. The expansion in the size of the child credit is expanded to 2025, but making it permanent and making the childless EITC more generous is a permanent change that's being proposed. And so the pay-fors. So part of it is that $80 billion is supposed to lead to $700 billion in increased money because of enforcement. So through the threat of auditing, having people sort of declare more of their money that we're not necessarily having people report right now. And so part of this has to do with the fact that people are really good at reporting all of their wage income or things that we have third-party verification that goes to the IRS for. Some of this other kinds of money, so especially on the financial side and not the wage side and small businesses, are easier for people to not necessarily fully report because there isn't a separate verification way. And so there was a paper done that sort of assumes that you would get a pretty large bang for your buck if you increase the amount of money that is sitting in the IRS. And part of this is because that funding has been cut over time. And so if we actually could get enforcement back up to levels sort of at the point where they were before, there might be more money coming in. Raising the top marginal rate to 39.6% from 37% for the top 1% of taxpayers, raising capital gains and dividends tax rates for those earning more than $1 million, limiting the step up of basis at death for high income taxpayers for those earning more than $1 million. So partly, and this might be getting into the minutia of federal tax code that you may or may not want. In general, if somebody dies, their estate automatically has any capital gains that they might have earned step up to the current value. So people who are benefactors or do not necessarily pay any taxes, it's not part of the estate tax. And so largely, if you die, any unrealized capital gains sort of disappear. So what this is saying is they're going to increase, they're going to make estates on your last income. So your income tax form that somebody is filing the year that they pass away would have to include a calculation of what the unrealized capital gains are before that money shows up in their estate. So that's a way of sort of accessing this money. There's also something, and again, it's only for people who are earning more than $1 million. There's an ending of a special real estate break where for commercial property, if you have rental property, you can take any capital gains up to $500,000 and roll it over into an equivalently priced property. It's ending some of the carried interest loopholes, which is largely about hedge funds and how hedge fund people get compensated. And it's also trying to get rid of some of the loopholes in this additional Medicare tax that is basically applied to unearned income for people who earn more than, say, $200,000. We don't have estimates of this. It is as in the report that came out in the fact sheet from the Biden administration, they said that they expect this to raise $1.5 trillion over a decade. But note, about half of it is coming from this improving enforcement and decreased tax evasion. So what does this mean for states? So there's a limited effect on the tax rate changes because that's not changing anything that has to do with AGI, but it could affect the timing of capital gains realization. So in general, when we see capital gains rates, so the taxes on capital gains go up or down. So if we think about with the TCJA, we see some shifting of capital gains realizations from one tax year to the other. So you could imagine that there's going to be temporarily changes in when we see capital gain realization. So partly before Biden took office, we actually saw a spike in capital gain realizations as people were nervous that these rates were going to go up. So there might be some timing effect. There could be pretty big increases in tax revenues if it is the case that people start reporting more income on their federal returns, because that'll flow through to their AGI at the state level. And if there are audits that are getting money in, piggybacking off of the federal audits at the state level is much more straightforward and a less expensive proposition than if the state was going to, for example, audit people directly, right? So some of the conversation about whether you want people to be able to itemize their deductions or not has to do with this record keeping. So if the federal government is doing the lion's share of that, that might be a way of getting some money in. Again, with the step up of basis and tax on unrealized capital gains and the other closing of loopholes, because that's expanding what AGI and income would be, that would carry through and we would see some of that money at the state level too. So anything that's expanding AGI will flow through to the state, whereas rate changes would not necessarily. And then on the other side, the EITC expansion, because there's that match rate, would cost money from the state, but it would be a way of getting more money to lower income people with that childless EITC. And it would not count if the state kept that as a tax cut. Something else to just keep in mind, we're hearing a lot of chatter about the changes to the SALT deduction and whether there's going to be some negotiation about changing that. Personally, I'm not sure I think it's going to go through. In the end, do I think that the people like if they have 50 votes, do I think Schumer's really not going to vote for the infrastructure bill, the jobs bill, or the family bill if they don't change the SALT limit? No. And so I feel like these are things that are being discussed right now. There are also things going on that we've seen a number of other people introduce other ways of expanding payments in terms of the child credit. So we have Senator Lee is introducing a different way of expanding the child credit. And so there's going to be some discussion and something going on in DC right now where they're going to try and figure out whether this is what the proposals are or whether there's going to be some changing or some movement in some of this. Should I stop there? I can't see if people have questions because of the way my screen is set up. But if anybody has any questions, I'm happy to take that now. I was also not necessarily going to go back through the other two parts of this. I think we've largely covered it. I don't have a lot to say about what's going on with the American Rescue Plan besides what we've already covered, just because we don't know yet. And then I don't know, I think there's going to be some maneuvering with the jobs bill and the family plan, right? I think they're going to be moving in lockstep, but I think part of it also might be pieces might be broken out to see if they could get some bipartisan support, and then other parts might need to be passed individually.
Kim, I've got a question
Sure.
on your comments about the sharing or the match rate on free community college education and preschool. Do you have an idea if that was passed? Would that be fiscal 22 or would it go into fiscal 23?
I would think it would be hard for them to get it into fiscal 22. And, you know, truth be told, we've had conversations with people from the Department of Ed who are trying to understand what it means to have, say, a maintenance of effort requirement in there. Just because anything that's sort of going off of this year, they're generally recognizing it's sort of a weird year. So trying to figure out what level of revenues you would need to be going to higher education from the state is kind of tricky. And so I feel like that's also something that will be worked out. I think that will sit at the Department of Ed, not Treasury. But I feel like there are going to be more of these conversations. At least we've started having conversations with people as this has been going forward for them to try and figure out how they're going to actually put that language in terms of making sure that the state matches there or the state maintenance of effort for any of this money continues.
Kansas has 19 community colleges, so that could be a significant amount for us.
Yes, but it like there is this sort of weird question about whether it is maintaining the same share of money that goes to higher education compared to other parts of the budget, and the fact that that doesn't recognize that you could very well imagine that the share going to higher education goes down either because enrollments are down or just recognizing that because of the public health aspects of what's happening right now, a state might be spending more money in other parts of their budgets because of the virus. And so they are aware that this is complicated and they're still trying to figure out what that's going to look like. And then I think the only other information I had, right, we know that the 13 states brought additional lawsuits. I think what's going to happen is going to be whether the courts are satisfied if Treasury gives specific enough guidance and they move away from this indirect cut kind of terminology. And then I think we just sort of saw the other thing. The other thing that I thought was notable is we covered that New York and some places are like taxing marijuana. Florida just approved Wayfair legislation. So they're going to basically be able to collect from Marketplace and from online sales. Louisiana has a bill going forward that's trying to coordinate one local rate for out-of-state sellers to use instead of having to figure out the local sales tax rate there. So there is some action going on in terms of what we see in terms of Wayfair and sort of what's going on with online sales. And then the other thing that was interesting to me is that New York just agreed to agree to federal PPP treatment, right? So the fact that some of the places that had been complaining about this have decided just to go along. And I think part of that has to do with the fact that they have money coming in, right? The fact that there's additional money from the ARP coming in has made it less of a big deal to just conform and not fight how they're treating that. And I
Did
think
Florida, in Florida's legislation on third party, did they have a de minimis in their legislation?
I believe they do. But I would need to check that, but I can do that. I think that happened on the 20th of April. But it was signed.
Are
So
there other, go
it
ahead.
was interesting because as of the 19th, the scuttlebutt was that the governor wasn't going to sign it, and then he did. So. Did you have other questions?
Further questions?
All right, I'm going to just stop sharing.
Good.
Oh.
Well, Kim, thank you very much. We really appreciate you helping us, not just now, but you've been very good throughout the last couple of years. I guess Richard's not with us today. Is that right?
He's on vacation today.
Okay.
And it seemed like I could sufficiently say that we don't actually know very much.
We know a lot. Thank you for your presentation.
Thank you.
Shannon Portillo, are you on? Yeah.
I am here.
Oh, very good. Shannon is bringing greetings to us from the Commission on Racial Equality and Justice. Thank you for doing that, and welcome to the Tax Council.
Of course, thank you so much for having me today, and I really appreciated some of you all from the Tax Council came and spoke with our economic subcommittee for the Governor's Commission on Racial Equity and Justice, and we were thrilled to have you present to us. We're excited to return that and present a bit of the work that we've been doing as part of the Commission on Racial Equity and Justice. So I'll start today by just giving you a bit of history and background on our commission. Our commission was established in June of 2020. This was, as we know, a period of significant social unrest after the murder of George Floyd, and Governor Kelly signed Executive Order 2048 at the end of June, establishing the Commission on Racial Equity and Justice. She asked us to study issues of racial equity and justice broadly across systems in Kansas, but given the events of the moment, we were asked to focus first on policing and law enforcement. So in our first year, we met as a commission every 2 weeks, and we held listening sessions with communities across the state, as well as experts on a variety of topics related to policing and criminal justice, and provided our first report at the end of 2020. But our commission has kind of broad perspectives from education, law enforcement, healthcare, and advocacy organizations. So our initial report, as I mentioned, was submitted to the governor at the beginning of December in 2020. And that report included over 60 recommendations to state agencies, the legislature, and local governments. We thought it was really important to divide our report into areas of authority. So we had recommendations that went specifically to the governor's office and things that executive agencies could implement on their own. We had aspects of our report that were focused on legislation, and then aspects of our report that went out to local governments. So things that cities, counties, and local police departments could do on their own. So we did, as we were talking about the criminal justice system, we know that there are a number of intersecting systems that create criminal justice outcomes, and we really are spending 2021 digging in a bit deeper to those systems. So in 2021, we decided to use a social determinants of health framework to really focus our work. And for those of you familiar with the social determinants of health framework, it really takes into account a number of different areas that shape the overall health of individuals and communities. So there typically are 6 to 7 categories here, but given the size of our commission and the work that we wanted to get done, we decided to focus in depth around economic systems, education, and healthcare. So our commission divided itself into 3 subcommittees, with the subcommittee focused specifically on economic systems, and that's the subcommittee that I'm chairing, and then a committee focused on education and a committee focused on healthcare. There are aspects of racial inequality that work across all 3 of these systems, and many of these still influence criminal justice, though for our purposes for 2021, our goal is really to dig in deep into each of these 3 areas and provide the governor recommendations with a report in July and a final report at the end of 2021. Those reports will be divided in the same way as our first report, with recommendations to the executive branch and agencies, recommendations to the legislature, and recommendations to local governments. So our economic subcommittee has met a few times, and we've really spent some time talking through what are the big areas of focus that we need to take on. And as I mentioned, tax policy is one of those areas. So we were incredibly grateful to the Governor's Tax Council for coming and speaking with our subcommittee about some of these issues. In June, we'll be taking up housing and homeownership and the racial gaps that we see in homeownership, as well as some of the historic inequalities that have led to gaps in homeownership, like redlining in communities and the types of predatory financing that some families of color experience today, and their lack of access to financing and federally backed loans historically. So we really want to see how some of these historic policies have shaped the current racial wealth gap, current racial gaps in homeownership, and what policies and recommendations we can put into place today to overcome those. We'll also be focusing on transportation and infrastructure. We know that communities of color tend to have infrastructure with more delayed maintenance than majority white communities. And so really thinking through how can we address that from the state perspective. We started with our very first subcommittee meeting talking about broadband. Obviously, in this time of remote work, we know that broadband access is a major issue. In the state, we tend to talk about this as kind of rural versus urban access, but we know even in urban areas where folks may have the opportunity to have access to broadband, there are still significant hurdles that create and reinforce the digital divide. And a lot of that has to do with access to devices to access broadband. And when you have families that may not have multiple computers, multiple tablets to get online, that still reinforces that digital divide that we see. Childcare is one of the issues that we've seen pop up on all 3 of our subcommittees this year. Obviously, childcare and early childhood education is a major area of focus for our education subcommittee, but we know access to quality childcare has important healthcare outcomes for our communities. And so our healthcare subcommittee has taken that up. But from our economic subcommittee perspective, childcare is one of the #1 things that we keep hearing about when it comes to access to the workforce and for workforce retention. So I'm a faculty member at the University of Kansas, but I also am a county commissioner here in Douglas County. And one of my first meetings with our newly elected sheriff, he brought up how he doesn't have access to overnight care for childcare. And so a number of his corrections officers have left employment because they didn't have childcare access for their family. And so he said from a criminal justice perspective, from an employment perspective, childcare was incredibly important. And I've heard this also from folks in our for-profit sector and businesses saying that access to childcare would increase our workforce participation. So all three of our subcommittees will be taking up discussions around childcare as part of our work, but we're going to be focused specifically on workforce and how childcare affects our workforce. And then student loans and education financing. This is again one of those pieces that really spans all of our subcommittees. Our education subcommittee is incredibly interested in education finance, but from an economics perspective, we know that student loan debt is one of the biggest contributors to the racial wealth gap. So looking at what are some of the things that we can do as a state to make sure that there's access to quality education for all Kansans, but that we're also not putting Kansans into debt in a way that's going to exacerbate the racial wealth gap. And then of course, workforce and workforce readiness. So how are we making sure that students have access to the training and education that they need and that our workforce is ready? Those are kind of our big topics. We could do incredibly in-depth reports on each of these areas and spend years and years studying every single one of them. We are moving very quickly through each of these to provide recommendations to the governor by the end of 2021. I remember when we were first talking about this commission, it's a big ask to think through all of the ways that we end systemic racism in the state of Kansas by the end of 2021, but we're working hard to try to figure that out with a pretty big variety of recommendations here. So a big part of what we have done is reached out to the community, as I mentioned, in 2020 in advance of our first report. We had 26 different listening sessions. Those involved community members, different experts, but we also wanted to find ways for the community to have access to the commission to provide us feedback on those reports and then also on implementation of some of those recommendations. So we have a phone number if people want to call us up and leave a voicemail. We of course have an email address. They can hit the post office and send a traditional mail with stamp on it. And we have a Twitter hashtag. So we're trying to provide as many accessible pathways for folks to give feedback to the commission as possible. We're really excited to be here and hear and learn from you. So a big part of what we're hoping the Governor's Council on Tax Reform can help us with is really think through the areas of overlap in our missions. So specifically, the Commission on Racial Equity and Justice would like the Governor's Council on Tax Reform to consider racial equity in tax policy. So we know there's increasing scholarship around the lack of racial equity and the structured racial inequity that comes from our tax system at the federal and state and local levels. So we would appreciate if the Tax Council could propose recommendations that address the impacts of race-based injustices on Kansans and ensure that recommendations have neutral or even better positive impacts on communities of color. We know that that tax policies are one way that we can really start addressing some of the historic racial wealth gap that we have in our communities. And then also hearing from Black, Indigenous, and other people of color in communities as you consider these recommendations. One piece that's incredibly important to us is thinking through what kind of data we have on this. We know that we don't have very great data when it comes to how taxes shape communities of color and how people are affected differently based on race and ethnicity. We are really excited about President Biden's executive order to collect more data around race and equity at the federal level. We're hoping that we can extend that and really think through what does that mean in our state and local government so that we have the data that we need to really see how our policies are affecting communities of color across the state. So I feel like I sped through that a bit, but we do have a website off of the governor's website that has our first report on it. It also has the recordings of all of our meetings, as well as some of our public notes. But I would love to just open it up now to discussion, comments, or questions that any of you may have for me.
Shannon, I would say that one of our major recommendations would fit what you're talking about, and that's a food sales tax rebate. We pushed that. Unfortunately, it hasn't been implemented yet, but we're still trying to push that.
I really appreciate that. I think that that's so important for communities across our state.
comments or questions for Shannon?
Shannon, how does your council propose to get the data that looks at how the different taxes affect different ethnic groups?
That's a great question, and we don't have specific proposals in mind yet. I would love to hear from you all if there are specific ways that you think that we can frame recommendations. I mean, our commission can only provide recommendations to agencies in the legislature and local governments to collect those types of data. And so if you have ideas of how we might frame those recommendations, I saw Kim popped back on, so I'm hoping that she might have some recommendations. And I know that Donna Ginther, who is an incredible colleague at KU, may have some ideas as well, but we would be incredibly interested in how we might frame some of those recommendations.
No, I popped on because it's hard, right? We're just trying to do this. And so as we move forward in this work, we're trying to sort of ask these same questions. So I think it's great you're doing this, but I do think it's hard, but the federal example should be helpful going forward.
I agree with Kim. It's very hard to get race. A lot of the data that I work with won't report race because the cells are too small, right? So they suppress it. Especially if you think about health disparities, for example, you need to see race in order to measure health disparities. But, there's some creative ways where you could look at the race of the population and then infer information about the disproportionate impact. And I would also sort of like second what you had to say about sort of like the higher education costs. As the state has cut support for the Board of Regents and the community colleges, the debt levels and the cost of higher education are going up, and that disproportionately affects students of color and first-generation students. So any cut of state support to higher ed will make it less accessible to people of color.
And I think with student loan pieces, I was just reading a report yesterday about how 5 years out of school, white students are more likely, or white graduates are more likely to have their student loans completely paid off. Whereas graduates of color, that's debt that tends to stay with them for much longer. And so then that does affect things like home ownership, starting a family, having the funds to pay for a healthcare crisis. And so I completely agree with you, Donna. I think that the increased costs, particularly of in-state education and community colleges, affect communities of color disproportionately.
Shannon, I assume you delivered some recommendations to the legislature. If you did, what kind of reception did you get from them?
We did deliver recommendations to the legislature, and we saw some legislation that considered some of our recommendations. Unfortunately, we didn't see anything that has made it to the governor's desk yet. We have a few pieces that are still alive. They've been kind of blessed and may come back during the veto session, but we're not terribly hopeful with this session of getting things through. We hope to continue advocacy with the legislature for the 2022 session.
We know how you feel.
So Shannon, are you also looking at access to the social safety net?
We don't have that on our list right now, but I'd love to add it. How are you thinking about that?
Well, I would say the two things to look at would be TANF cases by race ethnicity. The HOPE Act basically eliminated access to TANF in the state for all, but I presented some estimates that our time limits on TANF started having an effect on the number of cases. So you saw cases going down in the winter because people were running into their time limits for TANF. So looking at TANF caseloads by race ethnicity, also looking at foster care by race ethnicity. Zan Weedle at IPSR is doing some work with the Department of Children and Families. So so we have some data on that.
That's great. I'll reach out to Zan.
Okay, great.
Further comments or questions?
Well, one final point, and this may be relevant for Shannon Kimball as well. The education achievement gap, right, is very persistent. And one of the reasons why we had the constitutional crisis around school funding, because of how we were funding our schools and how it was contributing to the achievement gap by race.
Well, and I do think that the focus on early childhood is also meant to address that in a big way when it comes to readiness for K through 12. But I think that when we think through school funding, that will be an important part. And our education subcommittee is spending significant time talking through that.
Shannon, it sounds like you have a boatload of work to do and you've already done a lot. We appreciate you doing that, and thank you for presenting to us today, and good luck. We'll look forward to working with you.
Thank you so much for giving us the time. I really appreciate it.
You're welcome. Donna, I think we're ready for your presentation on economic updates and
Okay.
impact the tax issues.
All right, let me find my slides. So can everybody see the slides?
Yeah, yes.
All right, since I talked to you earlier in the month, I'm gonna have a very brief update on the Kansas economy. I'm gonna briefly talk about COVID, and then finally end up talking about tax policy considerations around SB 50 and other things we've discussed. All right, this is New York Times reporting on Kansas data, and cases are going down in 26 of the 50 states, but they're not going down in Kansas. Kansas cases have increased 2% in the past 14 days, but what is really shocking is that hospitalizations have increased 16%. So this is indicative that there's a lot of disease still out in the state and COVID is not over. We have had uneven uptake of vaccinations. Douglas County, where we live, is up to about 55,000 people vaccinated. About 38% of the Kansas population as of April 19th has received at least one shot. Darker colors indicate the counties where more people are vaccinated, and some counties are just not, people aren't taking up the vaccine. Why is that important? It's important that health policy is economic policy. And if COVID is not, finally eliminated through vaccination and health behavior, it'll just stick around and continue to circulate. And then these variants will gain traction. And that's kind of what you're seeing in India right now, where the crisis is just overwhelming the healthcare system. So I wasn't going to update any economic data, and then I opened up the newspaper this morning, or I opened up my browser this morning, and GDP numbers came out. And so we've seen a slight increase in Q1 in 2021 relative to Q1 2020. And I have the wrong text here associated with this, but we did see growth relative to the first quarter of 2020. We're not back to the level of 2019 growth. And Kansas economic growth is doing pretty well too. Where is the growth coming from? It's coming from goods. People are spending on goods, so they're buying things, especially for their houses, or they're buying houses, they're buying furniture. They are not consuming services. Services have not recovered, and some services may never recover, and I'll show you that why later. I showed you this slide before. Kansas unemployment ticked up a little bit in March, but unemployment, we're still down 8.4 million jobs compared to the previous year. And our employment in Kansas is down 3.4% compared to March of a year ago, and it's down 4.5% in the US compared to March of a year ago. We see a significant flatlining and decrease in Kansas initial claims as of April 17th. So only 2,000 claims, and that's number almost comes to pre-COVID levels. As we've shown before, the COVID pandemic disproportionately affected manufacturing, accommodation and food services, healthcare, retail, and education services. So these are the sectors that have been hit the hardest, but they're all coming back. The March unemployment rate by county is still pretty high around Sedgwick. It's still pretty high around Southeast Kansas and in Wyandotte County, but Johnson County is down to 3.1%, and Western Kansas never really had a huge increase in unemployment. That said, employment in our major cities, Kansas City is down in March 2.7% compared to a year ago. Wichita is down 6%. Lawrence is down almost 7%. Manhattan's down almost 8%, and Topeka's down 3%. So in our major cities where you see the highest unemployment rate, our employment has yet to recover. That said, I think in the next few months, we're going to see an improvement in the employment picture as well. Job postings, and this is from tracktherecovery.org, in Kansas are up 33% compared to January of 2020, which is pre-recession, and up 31% in Missouri. So that's very positive. The number of small businesses open in Kansas, however, has not recovered. So small businesses are down and less likely to be open, about 31% in Kansas and 27% in Missouri. We got updated PPP loans in Kansas. Statewide, as of March 3rd, 2021, the state has received $6.6 billion in loans. 1.8 billion went to Johnson County. 1.3 billion with a B went to Sedgwick County. And this was about 90,000 loans. So huge amounts of PPP money came in, and the tax implications of that are really costly because of the provision in the December bill. The average amount of PPP loans was highest in Johnson and Sedgwick. It was also really high out in southwestern Kansas. It ranged from 18,000 in Elk County on average to 122,000 in Sedgwick County. The statewide average was 73,000. So lots of money being pumped in to the state. And this retained a lot of jobs, especially out in Western Kansas. It retained between 26 to 59% of the civilian labor force in Kansas's 6 largest counties. This graph shows the loans by sector, the loans, the number of jobs, and the total amount. So healthcare and social assistance in the state got almost $1 billion and it preserved 112,000 jobs. So of the 6,800 loans, you preserved 100,000 jobs. Manufacturing had about 3,000 loans, preserved 72,000 jobs, and got $786 million. So the jobs, the darker the color, the more jobs preserved. The size is the amount of money flowing to that sector. So you see that arts jobs, they got about $1,300 loans. It preserved 15,000 jobs, but at a very small amount of money, 78 million. So in our different sectors, we had different benefits, but healthcare, accommodation and food service, construction and manufacturing were the sectors that benefited the most. So it's always good to put Kansas in context. Our consumption as of April 4th is up almost 13% since January of 2020. Missouri's is down about 5% and the US is up about 10%. And right on, so here's mid to late February, you see this acceleration in consumption. This is the stimulus. Those $1,400 stimulus checks went through the state economy. This compares how households are doing in Kansas as of the end of March in Kansas, which is the red bar, and the blue bar is the national average. About 47% of households have reported loss of income, 19% report food insecurity, and we have high rates of likelihood of eviction. I am very cautious about these numbers. We double checked them, but I just think the sample sizes are too small in Kansas for these to be reliable estimates. But they do suggest that there may be some housing issues in the state relative to the nation. And you see about 32% of households have difficulty paying for household expenses in Kansas, whereas 40% in the US. So Kansas, with the exception of the housing issues, appears to be doing better than the nation. So we are recovering. So, there's always an argument about what the shape of the recovery is. It looked like it was going to be a reverse radical, but now it's looking much more like a V shape. There is a question of whether or not the recovery is broad-based. And this K-shaped recovery is where the rich benefit and the poor or the low income don't. We're going to look at evidence for that in the US and in Kansas. In the US, as of February 12th, and this is from tracktherecovery.org, you see a K-shaped recovery. High wage employment is only down 2%, middle wage is down 8%, and low wage is down a whopping 30%. So as of February, before the stimulus took effect, you see a K-shaped recovery in the United States, but you don't in Kansas. Middle wage jobs are only down 2%. High wage jobs are only down 2%. And low wage jobs in Kansas are down 14%. So yes, low income households are doing worse, but nothing like they are in the United States as a whole. So overall, we're not seeing necessarily as much of a K-shaped recovery as the US is. The UCLA put out a forecast of the economic recovery, and it looks like their forecast was pretty accurate. It came out in March. They said that GDP was going to recover in 2021, and it looks like we're on track to recover GDP to its 2019 peak. What's driving this is that people who didn't lose their jobs have excess savings and pent-up demand. And so that is why you see all of this purchase of goods and services. However, employment is going to take a long time to recover. Our labor force participation rates are at 1976 levels. And many service sector jobs are not going to return. We're just not going to have as many low-skilled service sector jobs. So we're going to have a long-term unemployment problem for people with low skills. So what's driving the recovery? Well, first of all, the American Rescue Plan is pumping more money into households and has provided much needed support for state and local governments. Second of all, COVID cases have plateaued as more people have gotten vaccinated, and there's a pent-up demand for a return to normalcy. What could potentially slow the recovery? COVID variants that don't respond to the vaccine. So if people don't get vaccinated at high enough numbers, mutations may take hold and set us back. So what's happening in India is really a cautionary tale. They don't even know if it's variants or something else. The other issue, which is concerning, is that new variants are making younger people sick. I saw a headline that said that some children are on ventilators with COVID. This makes me concerned that it may be too soon to ease COVID restrictions, and many counties are easing COVID restrictions. A second issue that will slow the recovery is that many of the small businesses that closed, the 30% of small businesses that are closed compared to January 2020 may not return, and those service sector jobs may not return. So we may hit the ceiling of the recovery pretty quickly. And the ceiling on GDP is going to be higher, but the employment ceiling is going to take longer to reach. For now, I'd like to turn to tax policy. Secretary Burkhart spoke about this. And so Senate Bill 50 includes all of this decoupling. And when you change your policies in such a dramatic fashion with this decoupling, you create unintended consequences. Now, unintended consequences means full employment for economists. So economists are going to love that there's going to be state tax policy variation. I call the Affordable Care Act the Full Employment for Health Economists Act, because all these health economists study it. So this is great for my research, but it may not be good for the state. Well, note that decoupling only moves in one direction. SB 50 didn't decouple from that $360 million hit associated with PPP. And finally, decoupling only works for the wealthiest taxpayers in the corporations. It doesn't work for all Kansans. It only works for a small slice. So why are we going to change our policies and procedures only for the select few? So you've seen this before. This is the hypothetical taxpayers who will benefit from itemization. And you see that the top 18% of taxpayers are the ones who will benefit from itemization, where these are all returns. The orange are the people who are itemizing in 2017. The gray are the people who itemize after the 2017 tax change. And the yellow is the difference in these two bars, right? So the largest share are people who in the 100 to 250,000 level. So it's the very top of the distribution. We were able to use US income tax data to come up with an approximation by county of the number of people who would benefit from itemization from SB 50. And it ranges, the light blue are small numbers of people. So in Comanche County, 80 taxpayers. We estimate that 80 taxpayers will benefit from this policy change. Who benefits the most? Well, it's 80,000 taxpayers in Johnson County and 39,000 taxpayers in Sedgwick County. So across these different regions, only a handful of people who are wealthy will benefit in these light blue counties. Now, we can look at this from a population adjusted measure, but the maximum population is 27% of tax filers in Johnson County will benefit. These lighter blue numbers are 10% or below, which is a small number. And the medium blue is in the teens. So again, this is not all Kansas residents. This is just a small number of Kansas residents who would benefit. So GILTI, again, another policy that only benefits a select few. Now, guilt can be defined as something that's gold embossed, or it can be defined as a young female pig. So I had a friend when I was in high school who was a hog, her dad was a hog farmer, so I helped her show her hogs at the 4-H fair. The fiscal note is 24 million. It may not break the bank, but it will certainly increase the bank accounts of a select few corporations in the state. So you're going to create winners, and it's going to allow a select few corporations in the state of Kansas to become the tall hogs at the trough. Are we a state that wants to just let our taxes benefit the corporations and the people who made it through this pandemic recession unscathed? Are we going to allow our tax policy to give them even more benefits, given how corporate profits went through the roof at these larger corporations that have international footprints? So that's my comments on SB 50. There are some other alternatives to think about, and I'll just, some of this you've seen before. But the governor's fiscal year 2022 budget assumptions indicated that the starting point was agencies was a 10% budget reduction. Given that there's been an increase in funds from the April consensus revenue estimates, it makes sense to revisit budget cuts and restore agencies to full funding, right? We have full funding and we have the money to make agencies whole. And we are building these cuts on top of a decade of cuts to our government in the state. And so example A of the cuts to the government in the state would be the cuts that we made to the Kansas Department of Labor and ignoring the deferred maintenance of our unemployment insurance system that cost us a lot of money. So we need to be careful here. There is a provision in the American Rescue Plan that states cannot use the money to fund tax cuts or contributions to their public employee pension plans. We don't know exactly what this means yet, but if a state cuts taxes, it risks losing every federal dollar spent in violation of that rule. So it could double the cost of the tax cuts. You have decreased revenue from the tax cuts, and then you have a dollar for dollar reduction in the ARPA funds coming to the state. Are tax cuts that important? This is a picture of the PPP loan tax deduction. The size of the bubble shows the number of loans from that industry. The color, the darker the color, the more jobs preserved. You see, you have about 23,000 loans to animal production and crop production. But the number of jobs that those 23,000 in loans saved were not very high relative to food or health or professional technical or specialty contracts. So there's a 360 million fiscal note, and we're paying to conform selectively to conform to the federal tax code. We looked at sales tax gross revenue in selected sectors. This is food and services and drinking places, restaurants and bars, down 24 million between March and January of 2019 versus March and January of 2020. So we're looking at sort of revenue. This should be November, actually, March to November of 2020. So we're down 24 million in restaurants and bars. We're down 21 million in food service and in accommodations. We're down 16 million in accommodations, and we're down 14 million in telecommunications. We're up 13 million in general merchandise, 31 million in groceries, and 40 million in building materials and garden supplies. Now, this extra 31 million in grocery sales taxes really helped preserve the state budget. But food sales taxes in Kansas are a minimum of 6.5%, and in some places as much as 10% when you add in the local tax cuts. So House Bill 2091 creates a refundable food sales tax credit that we have discussed and endorsed in the Tax Council. And this is just, you've seen this before, but the current food sales tax credit is $125 non-refundable credit if your federal adjusted gross income is less than $31,000. The proposal will be $60 for single or married filing separately, $180 for a head of household with income less than $40,000, and $240 for married filing jointly with income less than $40,000. So each program will create winners and losers, but expanding the income threshold and making the rebate refundable would increase its impact, especially relative to any cuts in sales taxes, as I've demonstrated before. So heads of households and heads with 2 dependent children would benefit the most. So that's all I have. I'm happy to take any questions.
Well, as usual, you've done wonderful research, Donna. I don't know how you have time to do all that.
Thank
Good.
you.
Questions for Donna?
This is
Comment?
Sykes. I have a question.
Sure.
Donna, I had a conversation with Harvesters Food, and when you were talking about that $31 million in food, they were giving me a number because of the federal SNAP dollars that have come in because of the emergency order. They're estimating that was at 31 million. So is there a differentiation on if all of that increase is because of that increase in federal SNAP dollars that we get?
No, that's nothing. That's just, so SNAP benefits do not pay sales taxes.
Okay, so that increase in foods would be in addition. Okay, I'm just trying to look at that because they were saying if we lose the emergency declaration, that those federal funds, even though it's not taxes, our grocery stores could lose $31 million per month.
Oh, really? If those SNAP benefits go away.
Yes, those extra federal dollars that we get because of the emergency order.
And those are in the AFP as well. Extending that.
Extending that. Okay.
Thank you.
Yeah. So I mean, you can see that the money in restaurants and bars, the decrease in sales taxes in restaurants and bars, you think of that as almost a 1-for-1, right? So the reduction in eating out went into groceries.
Okay, that helps. Thank you.
You're welcome. Kim had a question about our estimates of newly itemizers, the difference between people who could itemize in 2019 versus 2017. 2017, yeah.
Wait, they're the people, oh, so are they not the people that would be able to itemize that aren't itemizing now?
Yeah, the ones, they're the
new-
net. It's the net increase in itemizers, not the total.
But from the law or from?
It's an estimate pre-federal change, after federal change, how many people lost the ability to itemize. We're just assuming that people would be restored to itemizing. And so we're looking at that change.
There might be more because if they were in that bubble before between the 2 standard deductions.
Right.
Okay, that was all I was checking. So it's just, I don't think it's the most, it's not the highest income people. It's probably the ones sort of.
No, the highest income people are already itemizing.
Right, exactly.
Now it's $100,000 to $200,000 range of adjusted gross income who lost the ability to itemize, who would then have that ability restored. But the geographic distribution is pretty surprising. Well, it's not, but it is.
Well, thank you very much, Donna.
Oh, my pleasure.
And we need to take a few minutes for committee discussion and possible recommendations. I would throw out that I believe that there needs to be 2 recommendations from us, at least. One of those would be our recommendations on the future of Senate Bill 50. And the other recommendation is, I think it's House Bill 2446. It's probably still in committee, but it has almost all of our recommendations in it. And we need to take a look at that and see whether we want to recommend the passage of that. So I would open it up for discussion.
Chris?
Yeah, I, just to follow up on Steve's line of thinking, I think Donna's presentation just crystallized my thinking about Senate Bill 50 and the governor having vetoed that. I think she made the excellent point that a lot of the people or a lot of the monetary benefit in Senate Bill 50, whether it's guilty or itemized deductions and some of the big ticket items, is going to people who were largely unscathed by the recent pandemic and its fallout. So I think I certainly understand the governor's having vetoed it, and if anyone's listening, I'd encourage them to sustain the veto. The other thing is with respect to one of our recommendations, and it might be in 2446, or Donna gave a different number, 2091. One of the recommendations we have made 3 or 4 times is sort of, I'd like to see us maybe double or triple down on the whole food sales tax rebate, going with the refundable credits. This ties in with some of the credits that, or the comments that Shannon made earlier. I think it would go a long way to reducing the regressivity of the state taxes. And I guess I view that as a better sort of targeted tax adjustment mechanism, given the environment we're in. The only other comment I have is I think Mark and Donna both mentioned this sort of 2-for-1 notion. I think we should encourage the policymakers to limit the net amount of tax cuts they make because of sort of the concept of opportunity loss. If someone's got $1 on the table and they want to use it to give to the highway fund or give to higher ed or make something on the expenditure side of the equation, in a normal year, it's, well, should we give the $1 back to KDOT or should we cut taxes with it, right? Or leave it in the ending balance for Adam's benefit heading into the fiscal year that starts 14 months from now. But that kind of 3-pronged policy decision is now different this year, because if instead of giving $1 to Adam's ending balance or $1 to KDOT, you decide to cut taxes $1, that's really a $2 tax cut. If I'm understanding the new federal law and its likely interpretation right. So the opportunity loss of going with tax cuts as a policy choice instead of doing something else with the money is really, really high. So I think we really want to target any kind of tax relief to the people who need it most. And in Senate Bill 50, as it's currently drawn up, that's not the people in my mind who need it the most. So a long way of saying, I guess I'd encourage us to recommend that the veto be sustained on Senate Bill 50, and then also keep working with, I know Representative Gartner is a big champion of this issue on the House side and Senator Sykes on the Senate side, but keep working with the policy, and Tom on the House as well. Keep working with the policymakers to get some version of the food sales tax rebate refundable credit back on the table during the conference committee deliberations.
I would second that.
Yeah, and I would agree with what Chris said, but I would add also that I think Donna in her presentation pointed out that 10% of the agency's budgets were cut before the governor even presented her budget. And a good example of the impact of those kinds of cuts over the years is the Department of Labor. And you look at that and some of the other departments also. And the fact that everything's still sort of unsettled. We don't know what will happen with all these new federal programs. I think Adam's budget profile showed the possibility of maybe $100 million in ending balance, depending on what happens. I think that we need to slow down and not get in a hurry on these tax cuts. If you think back to 2012, we were just getting out of the recession of 2008 and 2009, and we had that horrendous tax cut, and we're still looking at the effects of that. So I certainly agree with Chris that we need to recommend the sustaining of the veto.
Mr. Chair, if I can add some color, and I meant to speak to
Yeah.
this earlier, but you mentioned it and Donna mentioned this. So it's been mentioned a couple of times, so I'll come back to it as it relates to the SGF funding cuts. The original request was to be down 10%. The November CRE was better than the April of 20 CRE. So we were able to get some budget restorations, but still the large majority of agencies sustained a greater than 5% cut. So there were many that did sustain the 10% cut. There were a few that were at 0%, a few that were right around the 3 to 5%, but the majority of agencies were a greater than 5% cut, upwards of 10% cut. So to your point, to the extent that we have money available to restore funding to these agencies, because it's, when I think about it, I try to think of it as not as the agencies and the people I interact with day to day, but rather these services that these agencies provide to Kansans all across the state. And so a dollar cut to an agency is really cutting a program that some Kansan out there somewhere is relying upon. So finding a way to make sure that we can fund those services and programs.
Higher education has been cut. We're still taking money from KDOT. Deferred maintenance at the higher education institutions is a big issue. There's just a whole long list of priorities that should be looked at before we get into tax cuts.
Again, I would second Chris's motion to, as he stated, dealing with the food sales tax rebate and the governor's veto.
So we have a motion to support the sustainability of the governor's veto and some discussion. Is there more discussion? Well, I'm seeing no more discussion. All those in favor say aye.
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 Opposed, no. Opposed, no. Motion carried. And the other item I would suggest that we talk about is one of the bills that's in committee, 2446, House Bill 2446. I think it has what we've prioritized in the past, but it also has the guilty provision in there. Somebody probably should talk more about it that knows the details.
I'd be happy to. I've got the fiscal note pulled up, Mr. Chair, if you want me to walk through what some of the impacts are for 2446.
Please do that.
Okay, so on 2446, and this is on the legislature's website, the net impact to SGF only for fiscal 22 was 94 million, and then it decreases to 73 million in fiscal 23 and 74.5 million in fiscal 24. There's actually an uptake in highway funds relative to the marketplace and digital goods. So the all funds, if you will, is 77 million in fiscal 22, 54 million in 23, and 54 million in fiscal 24. At a high level, the key provisions would be to have the marketplace facilitator provision in there as per the tax council's recommendation, which does not include a de minimis threshold. That was the council's recommendation. There is the digital goods compensating use tax, which again was a council recommendation. Between the two of those, it brings in $90 to $100 million of good news between SGF and State Highway Fund. The refundable tax credit that Dr. Ginther spoke to just a bit ago, the fiscal impact on that is 54 to 55 million for the first couple of years. There is the disallowed business interest and guilty that you would have seen also in Senate Bill 50. This is in House Bill 2446. Between the two of those, we're looking at 54 to $60 million of downward impact for the first couple of years. The disallowed meal expense, which is negligible, capital contributions, deferred foreign income. There is a sizable increase in the standard deduction in lieu of the decoupling for itemized deductions. The first year impact for that is 73.7 million. The second and third years are closer to 57 million. And that just has to do with timing of the tax year and the fiscal year, why you see a jump in the first year. And then there's an expensing deduction provision, and this has been a request by some of the chambers, the local chambers, for a number of years, that the contention is made that this should have been reversed when the 2012 tax cuts were reversed in 2017, and it actually adds revenue to the state buckets. So clearly, as a budget director, I would support that. So again, marketplace facilitator and digital goods as recommended by the council, refundable food tax credit as recommended by the council, standard deduction increase as recommended, I believe, by the council, in lieu of decoupling for itemization. Then it also includes the disallowed business interest and guilty that were in Senate Bill 50. Those are the major provisions. And again, the SGF impact for 22 is 94.3 million. For 23 is 73.1 million. If you add in the highway funds, the total state impact is 77.7 million in fiscal 22 and 54 million in fiscal 23. And that's all on the screen. Thank you to Josh.
Thanks for that, Adam. Any discussion or any interest in 2446?
Can I ask a clarifying question?
Sure.
Adam, does that House bill also include the PPP loan deduction provisions that are potentially blowing such a large hole in elections?
For lack of better terms, it's silent on the PPP, meaning I don't believe that this decouples any provisions of the state tax code from that of federal tax code. So it shows an unknown impact of the PPP. I guess my take is that since we have now recognized the impact of the PPP in the revenue estimates, downward $360 million, it would take affirmative action to decouple to then put that 360 back in, if that makes sense. So the impact is still there. It's just in the CRE versus in this bill. Does that answer your question?
It does. I think I'm just trying to clarify whether if the council throws their support behind this bill, do we need to say anything about that issue in conjunction with our support for the bill? And I would be interested to hear others' thoughts on that. Thank you.
Gotcha. So I might just add then, and this is not to influence any decisions, or this is not making my opinion known. Just if we did, if the council were to choose to decouple specifically on the PPP, that would add 360 million in revenues across those 3 fiscal years to this fiscal note. So it'd be a net gain, it looks like, to the state. Again, that's just a statement of fact, not a statement of opinion.
The other thing in this bill that I would like to discuss is the guilty provision. I would personally take it out when supporting this proposal, when and if supporting this proposal.
And that would decrease state impact by 24 million first year and 23.5 and 23.
Yes.
That's correct.
Adam, if I'm looking at this correctly, is the marketplace facilitator, does it have a 50,000 kind
Yeah.
of minimus as opposed to the one that passed? I mean, the Senate and the governor's proposal had 0, and then what passed was 100. So this would be a compromise.
You're correct, Senator Sykes. I apologize. I was just looking at the fiscal impact. You're right. It does have a de minimis, but it's 50,000 instead of the 100,000. My apologies for that.
Do we know what kind of impact 50,000 would have versus 100,000?
I would defer to Secretary Burkhart. I don't know that he would have that readily available.
I assume it would be better than 100,000, but I don't know much better. Mr. Secretary, do you have anything on that? They may have had to step away momentarily. So.
Like they're getting their microphone coming together.
Can you hear me?
Yes.
If the de minimis only applies to marketplace facilitators and that's it, the 50,000 doesn't really have any real impact on us. The issue with the de minimis is in Senate Bill 50, it's applied to remote sellers, and therein lies the fiscal note. There aren't any, or we're unaware of any marketplace facilitators that are going to be making less than 100,000 or 50,000 sales into the state of Kansas. So the threshold doesn't become an issue there. It's more so in Senate Bill 50 that goes beyond marketplace facilitators and goes to all direct sellers. And as we understand House Bill 2446, it's just limited to marketplace facilitators,
Yes.
which, and that would be fine.
So if we would recommend the passage of 2446 without guilty, the de minimis would be a non-issue. What about the disallowed business interest? Are there, Adam, do you have any comments on that?
Outside of what the fiscal impact is, I'm not sure, Mr. Chair, what comments you would like for me to make. Is there a question?
I just don't know for sure what that is.
I might defer to, again, Secretary Burkhart and team on who that pertains to. That's all right, Secretary.
Yeah. Yeah, it's, it's just deductible interest, and there aren't any limits in terms of its deductibility, but it really gets down to a basic question of where do you, if you're going to do cuts, where are those cuts going to be made? And this fiscal note is obviously directed more at the business community as opposed to individual taxpayers. So more or less a policy decision.
I'll add something there. The disallowed business interest is very large amounts. So it's like, I don't remember the numbers on the top of my head, but it's like over $1 million or something, because I mean, less than that is allowed. So we're talking about very large businesses.
Right.
As I recall.
Tom, do you know why Jim put that in this bill?
Well, he was doing he put both guilty and the disallowed business interest as a compromise. He was trying to put together a compromise bill with the chamber, put in a couple things they want in exchange for getting a better marketplace facilitator and getting a bigger standard deduction. I think that was his reasoning.
Maybe we could take those two out and try to put something.
I think increase
in.
deduction more or something else that's.
Yes, yeah.
Yeah. I agree with that.
Just a thought, and I've talked to a couple of senators who the ad valorem, if you took those out, could that be replaced like a 2 years for the ad valorem?
The LVTRF? That would be 54 million, I think, is about what that is.
Yes, it is. That'd actually break pretty even.
That'd fit right in with our first, our recommendation.
Well, Mr. Chair, I would move that the tax council consider encouraging the passage of House Bill 2446 with putting in the ad valorem and taking out the disallowed business interest and the guilty. Does that make sense?
Yes, it does. Is there a second?
This is Shannon, second.
Okay, the motion is to recommend the passage of 2446. I think it's still in committee, and replacing the two items, disallowed business interest and guilty, with LA VTRF as an alternative. So discussion. All those in favor say aye.
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 Opposed,
Aye.
no. Motion carried. Well, thank you, committee. I think those are two very good recommendations. Further discussion from the committee or recommendations or ideas that we need to talk about before we adjourn? Well, if not, I want to thank everyone for participating today, and We'll let you know when the next meeting will be. We'll see what happens with the veto session, and that'll probably determine when we need to meet again. So thank you again for everyone being a part of this, and hopefully the people that are make the decisions on these recommendations will look at it closely. Josh,
Thank
is
you,
there
Mr.
anything else?
Chairman.
Pardon?
I said, thank you, Mr. Chairman.
Josh, is there anything else we need to do at this point?
No, thank you all for, I know this council has met a lot more this year. Thank you all for everything that you've put into this and all your questions. And thanks, Dr. Ginther and Urban, and all of the other guests that have been participating throughout this legislative session. It's been a busy year.
And I would thank all the presenters again that they presented to us today. We certainly appreciate that input and the continuing presence with us while we do our deliberations. With that, I would adjourn the meeting. Thank you, everyone.
Thank you.